A civil service pension fund just lost the fight it never got the chance to have, because the company it invested in had been lying to everyone, including some of the most sophisticated investors in the world, for 6 straight years. Retirement money for over 800,000 pensioners was on the line, and the fund had done almost everything a due diligence process is supposed to do. Act 1. The boxers leaving the fund's front door. On the 20th of July, investigators from Malaysia's Anti-Corruption Commission walked into the Kuala Lumpur headquarters of a fund called Kwap. They walked out carrying boxes. Inside were investment committee minutes, due diligence reports, and site visit records. The paper trail behind a decision made 2 years earlier. Kwap is Malaysia's civil service pension fund. It manages retirement money for more than 810,000 retired civil servants and holds contributions from a further 177,000 still working today. That decision 2 years ago had just cost the fund over 163 million ringgit. By the fund's own account, that loss is less than 1% of its annual investment income, a rounding error against total assets of nearly 195 billion ringgit. So why did a minority stake this small trigger a formal corruption investigation, questions in parliament, and headlines across 3 countries? Because the money was never really the point. The point is what got past Kwap's investment panel, its board, and 2 internationally recognized audit firms, and whether any pension fund in Southeast Asia could have caught it either. Kwap was not investing alone. Sitting alongside it in 2023 was some of the most experienced institutional capital in the world: Singapore's Temasek Holdings, Japan's SoftBank Group, the Abu Dhabi-backed Fund 42X Fund, a regional private equity specialist called North Star Group. All of them relied on financial statements audited by PricewaterhouseCoopers and Grant Thornton. All of them saw the same numbers, all of them were wrong. To 6.8 trillion looking for a home. Kwap's bet did not happen in isolation. Over the past decade, sovereign wealth funds and public pension funds worldwide have quietly become some of the largest investors in private markets, the unlisted world of venture capital that public exchanges never touch. A research firm called Global SWF tracks the shift. In 2014, these institutions held $2.8 trillion in private market assets. By 2023, that figure had reached 6.8 trillion. The reason is arithmetic. Pension funds face long-term obligations to aging populations that are aging everywhere from Kuala Lumpur to Jakarta to Manila. At the same time, contribution growth is slowing because fewer working-age contributors are paying into these funds relative to the retirees drawing from them. Meanwhile, public equity returns have struggled to keep pace with what these obligations require, so funds go looking elsewhere. Private markets promise higher yield in exchange for illiquidity, money locked away for years, sometimes over a decade, before it can be touched again. And as Kwap has now discovered, that trade comes with something else attached. Far less visibility into what a company's numbers actually mean. Kwap has grown alongside that shift. Established under a 2007 law to professionalize how Malaysia funds pensions for its civil service, the fund's assets have grown to nearly 195 billion ringgit, generating 8.3 billion ringgit in gross investment income for the year to December 2025. That growth matters directly to the 177,000 civil servants still contributing today, whose eventual pensions depend on Kwap finding returns strong enough to keep pace with a beneficiary base that keeps growing. 3/4 of the portfolio sits inside Malaysia. The remainder, including the stake at the center of this story, is where the fund has been reaching for the same private market yield that sovereign capital across the region has been chasing, from Jakarta to Manila to Hanoi. On paper, this particular bet looked like exactly the kind of reach that was supposed to pay off. Act 3. The books that told 2 different stories. The company was called E-Fishery. Founded in Indonesia in 2013, it built its reputation on internet-connected feeders that let fish and shrimp farmers automate work that used to be manual and imprecise. The company at the center of all this was called E-Fishery. It was founded in Indonesia in 2013, at a time when fish and shrimp farming across the archipelago still ran almost entirely on instinct and manual labor. A farmer would walk the edge of a pond, guess how much feed the fish needed that day, and scatter it by hand too little, and growth slowed too much, and money washed away into the water along with the excess. eFishery's idea was to replace that guesswork with a machine. Internet-connected feeders mounted at the edge of the pond that could dispense the right amount of feed on a schedule, track consumption, and report back to a farmer's phone. For an industry that had run on instinct for generations, it looked like exactly the kind of quiet, unglamorous automation that could reshape a whole sector from the ground up. Investors saw the same thing. By 2023, the company had raised $200 million in a single funding round, at a valuation of 1.4 billion. A forensic investigation by FTI Consulting, triggered by a whistleblower in late 2024, found that reported revenue of $752 million for the first 9 months of 2024 was in reality closer to $157 million, an overstatement of nearly 5 times. A claimed profit of $16 million was actually a loss of $35.4 million. And most strikingly, the company told investors it had 400,000 smart feeders operating in the field. Investigators found roughly 24,000. The fabrication reached back to 2018. 2 credentialed international audit firms certified the false numbers year after year because the deception was not sloppy. It was structural, sustained, built specifically to survive institutional scrutiny. On the 29th of April this year, a court in Bandung convicted E-Fishery's co-founder of embezzlement and money laundering and sentenced him to 9 years in prison. An appeals court reduced that to 6 years in July, while raising his fine. Malaysia's Anti-Corruption Commission has since opened a separate investigation into how Kwap's own investment was approved. That process is still underway with no findings yet made public. None of this makes E-Fishery's investors negligent so much as exposed to a specific structural blind spot that sits at the heart of how institutional due diligence actually works. On one side sits the audited paper, trusted reports, certified figures, signed off by internationally recognized firms. On the other side sits physical reality, 24,000 feeders, not the 400,000 the company claimed. In between sits the overlap that every investor is actually relying on. The assumption that what's on the page and what's standing in the water are the same thing. For 6 years, at E-Fishery, they weren't. And no one checking the paperwork had any way of knowing that from where they sat. Act 4. 2 paths from 1 right down. Kwap's exposure was small enough that pension payments were never at risk. Officials have said as much repeatedly, and nothing in the fund's public disclosures contradicts that. But a write-down does not need to be large to do damage. For a retired local council clerk drawing a modest Kwap pension, headlines linking their retirement fund to a foreign fraud scandal and a corruption probe are unsettling. Regardless of the actual sum involved, institutional trust once shaken does not repair itself at the same pace as a balance sheet. If the Anti-Corruption Commission's investigation surfaces process failures that go beyond E-Fishery's fraud itself, Kwap could face tighter political oversight over every future private market decision. That would discourage exactly the kind of higher yield allocation that pension funds across the region increasingly need to meet obligations to populations that keep aging. The more hopeful path is what Kwap has already told Parliament it is building: greater diversification across its private market portfolio, co-investing only alongside experienced fund managers, rather than entering deals alone, closer ongoing oversight of what happens inside the companies it backs. If that framework holds, and if other regional funds facing the same pressure adopt something similar, this collapse could end up doing more to protect the region's pension money than any audit report ever did. Act 5. Betting the region's retirement on its own growth story. Southeast Asia's pension and sovereign funds did not create the incentive to chase private market returns. Global capital did, moving from $2.8 trillion to $6.8 trillion in under a decade in search of yield that public markets increasingly cannot supply. What this story exposes is that the region's own retirement savings are now part of that same current, funding the same hypergrowth startup stories that made Southeast Asia's tech sector look unstoppable through the 2010s. Kwap is not the only regional institution reading this verdict and wondering what its own portfolio might be hiding. Temasek, SoftBank, and the rest of the consortium lost money to the same forged numbers, and they had considerably more diligence resources than a Malaysian civil service pension fund. If the sharpest institutional capital in the world can be shown 2 sets of books and believe the wrong one for 6 years, what does that say about how much verification any single fund can realistically demand? Perhaps 810,000 pensioners will keep receiving their payments, regardless of how the corruption investigation concludes. That much, at least, is settled. What isn't settled is what happens the next time. The next fund making a private market bet on the next celebrated regional startup will be sitting across the table from the same kind of confident founder, looking at the same kind of audited numbers E-Fishery's investors once trusted completely. The paperwork will look just as clean, the auditors will carry just as much credibility. And once again, somewhere in Kuala Lumpur or Jakarta or Manila, an investment committee will have to decide how much of that trust it can actually afford to extend. I am Hiro the Hornbill, and this is the ASEAN Angle.